Welcome to the latest installment of ABL Advisors video series featuring thought leaders from the asset-based lending industry. I'm Mike Togley, the publisher of ABL Advisor. I'd like to welcome our guest today, Paul Schaldiner, the Executive Vice President of Rosenthal & Rosenthal, who was recently promoted to the position of Chief Lending Officer effective January 1, 2022. Thanks very much for being here today, Paul.
Thank you, Michael. My pleasure to join you today.
Thank you. Well, the recent announcement caused me to want to give you a call to get your thoughts on what's going on in the marketplace today. Congratulations.
Well, thank you very much. It's very humble and honored to be selected for this position. A lot of exciting times at Rosenthal & Rosenthal. You know, we're 80 plus years in business, family owned and operated. And I think, you know, we're going to see, we've been, you know, some new initiatives that have come out. And certainly a lot of people in the organization have been promoted recently. And we think there's very exciting times to come for Rosenthal & Rosenthal.
Looking forward to it, Paul, absolutely. So what I'll do is today I want to talk to you a little bit about your thoughts. As you know, Rosenthal & Rosenthal is one of the oldest asset-based lending shops in the United States. And now that you're going to be the Chief Lending Officer, I thought it'd be good to get your thoughts on what's happening in the marketplace related to asset-based lending, purchase order finance, factoring. So with that, I'll start right in, if that's okay with you.
Sure, that's great. So I think what we're seeing, if you look at the sort of the world we live in today, I think there's some key components. If you looked at, I think the number one component, and you look at sort of the post-COVID or during COVID environment, has been the influx of government money. I know we're going to talk about that. That has had a dramatic impact on factors, asset-based lenders, even banks, purchase order financiers, because this the layer of capital that had never really been there before. Certainly you had SBA loans and so forth, but not to the extent that we find ourselves today. That has reduced the amount of reliance on borrowing on factors, ABL, PO, across the board, because of really relatively inexpensive government money on very favorable terms, or what's perceived to be very favorable terms. So I think that certainly has had the most recent impact. It's forcing lenders to develop agreements and subordinations and intercreditor agreements with government that has been, some cases has been fairly straightforward, but over time it's gotten more complicated as the influx of the Main Street program and some of the other programs, EIDL loans. So that I think has definitely had one of the key impacts, what I would call on the commercial finance sector. I think at a certain point in time that money will be reduced significantly, and it should be reduced significantly, because it's not the government's role to basically continue to subsidize our borrowing community. That's what we do. We lend to these borrowers. And I think ultimately, regulation with respect to credit, I think there's been companies that have struggled, even pre-COVID, and certainly have maybe struggled during COVID, where because of this lifeline that they received from the government support has probably sort of kicked the can down the road in terms of the turnaround. And typically commercial finance companies are a viable source of turnaround financing historically. So I would say that would be probably number one. I think number two, one of the key things, which we can certainly, I know we'll talk about, is this whole concept of what we've seen in supply chain and supply chain disruption. That is a significant impact. That impacts every walk of life that we're in, whether you're a lender or not a lender. It affects all aspects of business. We're seeing that as a significant issue for anybody who's involved with any type of product being made anywhere in the world. So I don't think, we'll talk about a little more detail about that later. And then I'd say the things that we're looking at also is pending inflation, what that might do to the economy, these large tax increases that are planned, the deficit spending, what we're going through right now, what we're seeing in Congress. I think those have potentially more macro impact on what would be the borrowing community that the factors, asset-based lenders, and commercial finance companies serve.
That's a great summary, and thanks very much for that, Paul. It's going to sort of, let's use the term unpack that a little bit. I'm going to focus a little bit first maybe on PPP and the government stimulus packages. As you said, it injected a tremendous amount of liquidity into the marketplace, which impacted all types of lenders. Now that that's sort of running its course, it's not completely run its course, but some will say it's run a good portion of its course. Do you believe that we're going to see borrowers come back to the PO financiers, the factors, the asset-based lenders, that they're going to come back in a more traditional fashion, looking for the same types of loans? I know you said that some of the lenders had to modify that they were underwriting deals, or actually even documenting deals. Now, do you think that that's going to come full circle to some degree? Or do you think we're in a new reality of how we're going to be doing these types of deals?
I think they will be back. I think ultimately, yes. I think this type of financing is clearly needed by what I would call the SME, small to middle market type lending community, all going up to very large entities that use some form of asset-based lending. I think that there is certainly, I think the PPP money will unwind. I think the companies will have to come back, and how do they fund working capital? They're going to need all forms, whether it's working capital facilities, whether it's facilities to affect buyouts and so forth, leverage transactions. I think all of that will come back. It's, like anything else, asset-based lenders are used to being cyclical lenders. We're in another one of these cycles, although it's certainly very unique for all of us that have ever been in this business. We've ever seen anything like this, but I think it will come back. I think there's going to be aspects, I think technology, data, new entrants, new types of lenders, whether it's family offices, whether it's people like Amazon and companies that are getting into the lending business. So I think those are the things that I would tend to watch as it relates to how loans are made in cross-factoring, asset-based lending, PO financing. We're watching all of that. We're watching the world proven to be totally interconnected. I think ultimately we're going to see the ability to be a cross-border lender. I think it's coming as a result of things like blockchain and technology. Back to that again. If we can navigate the legal side of some of this, cross-border international, I think the world, as I see it, we're going to be going in that direction more and more. It's a matter of time, but it will happen.
Yeah, and it's the evolution, right? And sometimes a circumstance such as what happened over the past, let's say 18, 19 months causes that circumstance causes things to move maybe a little more rapidly to the positive side as well. Now, one of the things that's in the news, and you mentioned, obviously, that's impacting the economy and impacting lending, is the supply chain issues. There's a lot out there about it. Ports not being able to process products, a lot of reasons that there's problems in the supply chain. But this certainly impacts the lending community. What do you hear? Are you hearing anything specifically from borrowers today? I always think about the borrower when I speak to somebody on the lending side as well. What are you hearing from the folks out there that are your borrowers? What kind of problems are you hearing about, and what's concerning them the most? What's keeping them up?
So I would say, in respect to supply chain disruption, I think the key is the ability to get product and get it on time and at what price they're going to get it. Depending on whether you make goods domestically here in the United States, whether you import finished goods from overseas, there is a natural, what I call, interconnected web of vendors across the board. If it's the vendor that supplies a widget that's being used to manufacture, something going into a car in the United States, whether it's somebody importing apparel from China or Vietnam, but fabric is coming from Italy or some other country. I think what we've seen is the problem is, number one, how can I make sure that my supply chain is secure, that I'm going to be able to make sure that everybody basically works in the supply chain, that every aspect of it, it's sort of what I call a deeper dive or a deeper look back into exactly where whether it's components or finished goods, where are they coming from? Can they be manufactured? And then the other main issue is, now we talk about, okay, how do I get the product to where it needs to be? Well, we've seen freight costs go from $3,000 to $4,000 a container to over $20,000 a container. That cost is exponential. Companies don't necessarily have margins to be able to absorb the increase in freight. I've seen situations where I've had a company with a fairly low cost consumer product where, believe it or not, the cost of the freight is more than the cost of the product. I mean, how do you, so business decision is being made in this case, in this particular scenario that I just saw recently, is that they're tapping every source to get, whether it's a retailer that's going to improve the price, whether it's a supplier that's going to reduce their cost. Everybody's sort of sharing the pain, but I would tell you that the end game of the company is a borrower says, I'm willing to even sell at a loss to get me through this cycle, because if I don't have product and I can't deliver, I lose that ability, that customer. And if it's a 3 to 6 or 9 month problem, does a company have enough capital to absorb this? Do they have a lender that truly understands the nature of the problem and is patient and can be patient? If they can, this is the time what I call factors, asset-based lenders, PO funders. We're rolling up our sleeves and we're getting down into the nitty-gritty to be able to basically assist our clients in getting through what we all hope. Again, realistically, I still think we're into the second quarter of next year before we see real, maybe potentially change back to the way things were.
Yeah, and as you mentioned, that's interesting because so it requires the relationship actually take a different course in some ways. We've always tried to stay close to the borrower. But in this case, as you said, you're rolling up your sleeves, you're getting deeper into this, but also you're getting into maybe the understanding that the dynamic is different than it's ever been before for some of these clients. So it's not the traditional way of looking at a distribution company, a wholesaler, whatever it might be. Now there's a whole new risk involved there. So your credit underwriting parameters, do they change to some degree? The word maybe change isn't the right one, but are they more flexible and maybe malleable to maybe work better with the borrower because of that? Maybe you've taken a more stringent stance in the past, but now if you really believe in the borrower and you trust the borrower and you've been working them for a long time, you can find a different way to do these deals.
I think we will definitely have to be more malleable. There's no question about that. I think the more information that you have as a lender, I would tell you that the first step, and just PO financiers or purchase order funders have always been, I would say, at the forefront of understanding logistics. It's sort of the lifeblood of executing a purchase order financing transaction. More so than, let's say, when I was an asset-based lender or an factor. Not that you weren't attuned to it, but I think what this is forced is that the lending community is definitely now has a much more better understanding and a greater respect for the impact of everything that goes on in supply chain. Because, as you said, one bottleneck in the supply chain, we got ships that are sitting out in Long Beach that can't get into the harbor, or can't get out of the harbor because they can't hire stevedores to take the product off the ship. Needless to say, we can't get enough truckers or trucks to get the product from out of the port into the hands of the various distribution channels. So it's kind of like this domino effect that I think that for the first time, really first time, lenders have a much greater appreciation for that. So as part of, I would say, credit and underwriting standards, I think that lenders are looking at the supply chain much deeper, making sure they understand logistics, making sure they understand the impact of freight on gross margin, and understanding production and trade cycle. Production and trade cycle is they got to take a much more visible, our clients should have a much more visible look to their source of supply, and hopefully the diversification of the source of supply. I think a lot of that is going into the underwriting of lending requests. And I think that, to be honest with you, I think it'll be here to stay. I don't think that's going away.
Yeah, and that's interesting also because we talk about the borrower here for a second here. They've always come to you with a certain business model that they've had, and they've always known the risks that are in that business model. And today, supply chain has created an entirely new risk. Does that in some way impact, in your mind, the type of lender that they're looking for? So, for example, would they someone who's been using an asset-based facility, an asset-based credit line, for example, would they suddenly be considering more of a purchase order finance facility? or factoring facility? Do things change because of this? Do the borrower's expectations, in other words, shift?
Right. So I would tell you, let's go back to COVID, for instance. You know, one of the real benefits of factoring has always been credit protection. It's basically any non-recourse factor providing credit protection effectively is almost like a credit insurance product. But with factoring, not only do you get the credit protection, you get real-time information on the status of your customer base, but you also get the ability to have somebody basically serve as your accounts receivable administration, outsourced AR administration, handling your ledgering of receivables, the bookkeeping, making collection calls. So I think during COVID and even today, there's a much greater appreciation for what a factor can bring to the table. I think it's been a renewed interest in factoring. I think the credit insurance markets we saw, while they've improved dramatically, there was certainly an impact during COVID of availability of credit insurance. And I think factors are very, very close to the end debtor base that their clients sell to. So the better factor out there is really a vital source of credit information, as well as, you know, credit administration for any borrower. So I think factoring has certainly made its way back. It's not just about money. Money is a part of it. It's your funding cash flow, you're funding working capital of a business. But I think factoring has become a much better appreciated product as a result of COVID and post-COVID. I think ABL, I think is there's a lot of activity in ABL. It's I think borrowers have the advantage of, they're going out today and they could have 3, 4, 5 proposals in hand from a slew of asset-based lenders. And sometimes, when you, as an asset-based lender, when you're competing against commercial finance companies, you're typically, the pricing is going to be typically in the same area. It's going to come down to the structure, going to come down to the relationship, going to come down to, does that asset-based lender have a particular experience level in an industry that the other one may not have. I think we're the purchase order financing. I think today, with the knowledge of supply chain, and even my competitors in the space are all well versed in understanding supply chain and logistics. And I think there's, again, another appreciation when you have conversations with borrowers, and you can have a detailed discussion of, how do I solve this problem? A PO financer has a certain skill set that helps to resolve and can mitigate the risks in supply chain. So I think all of those things are important. I think it's in the ABL world, I think what we're seeing also is just a wide swath of capital ready to be employed, dying to be employed. And we're seeing, again, as I mentioned earlier, you've got, not only you got banks, that have left ABL, that have come back to ABL, regional banks, community banks. Then you've got, the slew of, non-bank lenders, some of which have gone out and done deals with private equity companies that are supporting them, that again are looking to employ capital, family offices, and then right through to the Amazons and people like that, and these supply chain programs that are being set up by retailers who have strong balance sheets that are looking for extended terms, and use their own balance sheet to effectively put cash flow and provide capital to their vendor base. So a lot of these things, the preponderance of all these things that we've seen have made, I think sometimes it's great for the borrower. Sometimes I think it adds confusion of the borrower.
That's a tremendous amount of information. It's an interesting outlook as well for how it impacts every sector of what we'll call asset-based lending, factoring, purchase order finance, that entire world. Paul, you've given us a lot to think about, and certainly we've touched on what are some of the most, prevalent economic factors that are impacting the industry right now. With that, I think I'm going to wrap up the interview, but I was curious, is there anything I left out of this that you think we need to talk about today for any reason?
I think it's important to understand that, we have discussions all the time and amongst my peers in the community, and we always say, oh, look what's COVID's done, look what's gone on here. If you look really at historically, asset-based lenders have typically thrived, and I call it factors, whether it's a factor, an asset-based lender, PO funder, whatever it is. We sort of we've always thrived on some form of disruption. You know, the economy is too good, the economy is too bad, credit's too tight, credit's not available, too much liquidity, not enough liquidity. We've always, that's why we exist in the form of financing, because we really help to help borrowers through disruption. We offer a product, whatever the product may be along the spectrum of commercial finance, but it's something where I think we're cyclical, we deal with cycles. This is another cycle, although it definitely has its different challenges than we probably have ever seen before in most of our careers. But I think ultimately, I think what's key is keep that in mind. It's a cycle. We're gonna manage through the cycle the way we do, because asset-based lenders, commercial finance, manage collateral, and as long as you understand the collateral, you can track the collateral. You understand industry trends and what's going on with your borrowers. The more information, the beautiful thing about technology, that's the final point I'll make, is that technology more and more is becoming integrated into how we run our businesses as lenders in the commercial finance. I think that's not going to stop. It's going to become more and more data driven, more and more technology, that if we can avail ourselves of these tools, it helps us continue to manage through not only cycles, but pandemics.
What a great summary and wrap up, Paul. I can't think of a better way to do it. So thank you very much for being here today. I wish you much luck in your new role, and I know that you'll be successful. I know the Rosenthal & Rosenthal will continue to be successful, and my best wishes for the end of the year.
Thank you very much, Michael. It was my pleasure, and really enjoyed spending time with you and chatting about what's going on in our industry. So thank you very much.